Hi everybody, I left the last video on asking you where in your opinion are the big buyers located, so you can extract some useful information so you can implement it into your trading style. I would like you to bring your attention to this part of the chart. Where in your opinion are the big buyers? So when we start analyzing the chart from the left to the right, you'll see that there is this extremely big green candle, which means that there are lots of buyers, institutions rushing in to increase the price of the euro dollar. So it means that most probably this was initiated by some event, although this is not necessary. I have seen many times when the market volatility is going down, and at the same time we see some dramatic movements when it's more easy uh, to make make an impact, so to have an impact on the markets. Anyway, so if you concentrate on this area, you see that it's almost a pure green candle, and then it is followed by a red little bodied candle, and then another green candle which covers the which thoroughly covers the red candle, and it means that buyers are very certain taking control of the small portion of sellers, and the rally is going to continue. This is what really happens, as you can see. For the rest of the uptrends, we have another green candle, then we have a consolidation periods, and then next day the buyers rush in and lift the price up to new highs. So in total you have about 300 pips move for the euro dollar, and that's from the low point here to the high. Okay, so what is important to note here, as I said, it all starts with the green candle right here where all of the buyers are located. So in such periods it is good to look at the price action and to place your stop loss. So if you're going to go long, you should be waiting first of all for a close on the hourly chart, and then for another signal. As I said, there are after the big green candle there is a small red candle, which means profit taking and a bit of hesitation, and then more buyers come in, which are overlapping the red candle right here, and they're giving some clear indication that the price uptrend is going to continue. So that's where you actually should place your buy orders right here. This is the level that's you should be taking a quick decision, and if you're entering here, your stop loss should be a bit below the middle of the big green candle, because that's the place where most of the buyers are located. Then you see that the price continues, and we have another green candle. Then if you're at this moment of time here and you're wondering what to do, first of all, it is a good idea to wait a bit for correction, and then if you're going to enter and want to go long, you should be looking for a point where it is the midway of this big move. So for example, should be about should be around this area here, and you see the price touches several times the upper boundary of the midpoint of the second green candle. And if you're using price action, the points where we have a clear indication of going long is when you have more buyers than sellers. You have a little red candle and then a bullish engulfing pattern here, so that's a place very suitable for entering on the long side again. And if you go long at this point, let's see here, you buy there, you should place your stop loss just a few ticks below the nearest low points, which is the shadow of the red candle right here. So this is something like a 1 to 2 ratio. You're risking that much, and your potential target should be about 2 times higher, which is easily reachable. You can actually even make a 1 to 3 risk to reward ratio. So right here you should be exiting your, once you reach your target, you should be exiting your trades and looking for another potential setup, which in the next a few hours, in the next day, we are seeing a consolidation phase. And when you keep on going further up and further up, you see that here some sellers are coming in, taking control from the buyers. We have a bearish engulfing pattern, and then a more decisive signal is given right here with the big bearish engulfing pattern, which actually engulfs most of the price action from the previous day, which means that all of this hesitation is finally given a direction, and a quick signal which covers all of these buyers and sellers taken together is given. So if you're shorting at this point, if you go and sell right there, you should place your, ideally you should place your stop a few ticks above the highest point here, or otherwise, if we have such a quick action and you're not willing to risk a lot, but at the same time you're pretty sure from a smaller time scale that the price is not coming back to this high level, you can just place your stop a bit higher than the middle of the candle. So, but as I said again, you should have a clear indication from a lower time scale, like 5 minutes or 15 minutes. So by the time the price goes down and then starts climbing up to retest your entry place, you see you start having more sellers and more sellers here, and then when the price retests eventually this resistance area, it quickly jumps down and falls to approximately 200 points. So once you reach your target, it is a good idea that you close your position and you're looking for another place to enter. But at this moment you'll be pretty lucky because the price action is quite quick and you'll catch most probably the whole action. And since you have no other indication that sellers are pulling out of their trades, you see that the price action continues. You have more sellers here, more sellers here, more sellers here finally, and most probably the sell-off is going to continue because there is no major buying pressure, and after this consolidation phase you'll probably see another sell-off. So that's pretty much it for this video. Thank you very much guys, and have a good day. Hello everybody, this is Ati from forexpreparation.com. Today I would like to talk a bit about market psychology and the way I trade, and the best way to do that is to start with a short introduction about trading, and that's in my opinion the great trades do not require predictions because they're based on something that has already happened, and that's why most of the great trades are incredibly obvious. But of course there is one factor that is a key, because otherwise if it was so simple everybody would have been a multi-millionaire. So in my opinion the most important factor about successful trading is the implementation, and it is more important than the trade idea behind it. So having a great idea will not get you far if you don't do it the right way. That's why if you want to be successful in trading, you just have to pull a trigger sometimes and then think. So in my opinion, that's it is very important that sometimes you just get into a position with a very small, into a trade with a very small position, so you can feel the trade and then you decide to whether to cut your trade or just to start scaling in at appropriate levels. So here comes the most essential thing, and it is position size. So it should be your position size and your stops should be as big as necessary to compensate for daily fluctuations. So for example, if you're putting an automatic stop, it should be in a place where you're sure that if you're right, the price won't go there. So that shouldn't be, that should in any case shouldn't be a predefined number like 10, 20 or 30. It's should be a level corresponding to the current trading environment. Therefore, I don't recommend that you're using set rules. So in my opinion, they do not work here because the markets are changing very dynamically every day, every hour. So you should use your own flexibility and reason to place your stop every time you trade. That's why I believe that automatic systems do not work well, and the best the best trades are coming from your own intuition, which is actually based on your past experience and subconscious thinking. That's why I believe that the right key to successful trading comes with experience, and with experience comes right positioning. So you should be scaling in when you're on the right side of the trade and quickly scaling out when you're wrong. In my trading, for example, I do not use indicators. I just use the psychology of the market by implementing price action and matching patterns on different time scales. I use daily for the general picture of the markets, 1 hour for giving me the potential signals, and 5 minute time scale for precise entry levels, so I can minimize my risk. And because I know when, for example, there is a big trend like a straight line like here, I know exactly where I can enter and put my stop levels, but it should be really a quick move, a straight line like this one in the center of the chart right here. So now let's look at an example. It's a good moment to look at the chart that is in front of you. As you will see, actually there are two examples that I have prepared. One of them is the one that you see, and the other one is this one. So I'll concentrate first on this euro-dollar chart from 2008, and I have chosen this screenshot from 2008 on purpose. I'm not going to use a real-time chart right now for my first video, so I would like to show you that actually the general psychology of the market players was the same in 2008 and 2013, when in a later video I would be showing a live trading on the currency market. So I believe that it will continue to be the same in the years to come, because human nature is the only thing that doesn't stop working, unlike indicators and other trading techniques which are working for a certain amount of time and then they stop working. So what I'm looking at this chart is pretty much where the big buyers are located, and I would like to ask you to think about this for a few seconds before I continue. Where in your opinion the big buyers are located, and how is this action expressed?